Okay, welcome everybody. This is our fourth quarter 2024 capital markets and economic perspectives. And I'm Ivan Illan, the founder and chief investment officer at AWAIM, Aligne Wealth Advisors Investment Management. Very happy to have you with me today. And we've got, I think, some very interesting bits of research to share with you. And I think what's important to note as we go through these, I'm going to take more of a tactic of or the mindset of opportunity. There may seemingly be many things that we'll review in this presentation that look maybe scary or even dire, but we don't see it like that. The way we view it is if you are seeing things in the data, if your research is pointing to things of concern, that's a good thing because it means you can do something about it today. And so in our client portfolios, we're very much prepared and positioned according to exactly what we'll be sharing with you in terms of things that we see happening in the capital markets. As you see here at the bottom, we're going to talk about stock markets, bond markets, real estate, economic data, and touch on different aspects within these that all impact the asset allocations and the sub-asset allocations within our client portfolios, which is the ACGM Total Portfolio Solution Suite. You'll see here some disclosures, and you can press pause if you're watching this as a recording and read these diligently. Also, throughout the year, every month, there's a Forbes article that gets published that I write, and I've been doing that since 2016. Also, X and LinkedIn posts and our YouTube channel. There's quite a lot of content that we'd like to push out so that our clients and our network at large are kept up to date on what are we concerned about, what are we excited about, but more importantly, what are we seeing, and sharing that research and sharing those perspectives. At any time, please feel free to type in some questions that you may have into the Q&A widget through Zoom, and I'll be able to answer that as we go through. Also, if you're not familiar, you can check out our suite of portfolios on our website and the description for each of those. And if you'd like to have more information on those, don't hesitate to reach out, and we'd be happy to share with you our most recent fact sheets on these portfolios. These are global macro portfolios. They invest in cash, stocks, and bonds, and are quite decisive in how much cash or stocks or bonds they may have at any point in time throughout the market cycle and economic cycle. So with that, let's dive right in, looking at stock markets. So one of the first things we are seeing within the stock market here in the United States, and specifically taking a look at the S&P 500 Shiller-CAPE ratio. Many of you may be familiar with the PE ratio, price earnings ratio. Well, the CAPE ratio is simply a cyclically adjusted price earnings ratio. And Bob Shiller out of Yale developed this many years ago. And it smooths out the price earnings ratio so that you don't get such a whiplash in the normalized or typical PE that you see being published. So right now, this CAPE ratio is sitting at around 35. This is about 26% higher than its 30-year average. And you can see that there's quite a bit of cyclicality to it. But sitting at around 35, it's close to and near highs that we've seen in the past. Now, of course, this period back here, 1998, 1999, right before the dot-com crash, this was really sort of an extraordinary period of euphoria And and obviously there were companies that were even IPOing at the time that didn't even have revenue. So it was a highly distorted period of time. And you can see that it was quite a correction, quite a crash that occurred after that. Many folks remember the dot-com crash or have heard of it. This is the great financial crisis, which actually had a CAPE ratio that was very much near the average. And there was quite a collapse from that. And then even as recent as the pandemic, a little bit above average going into the pandemic, and then a bit of an adjustment after. But you can see with all that support that came in from the government thereafter, there was quite a run up in the pricing within the S&P 500, then a bit of a pullback to average. And now we find ourselves, even during this period of Fed rate hiking, but where the Fed funds rate has gone up quite significantly, there's really been a run up in valuations. So this obviously gives us a concern and something to be aware of. And anytime you are significantly above long-term averages without necessarily the earnings growth justification to support it, that's something to be aware of. And it's one of the reasons why in our portfolios we are significantly underweight S&P 500 market weight exposure. We do have S&P 500 exposure, but we've done so through equal weightings, both with the 500 and the 100 within the S&P. And we're comfortable with that because that gets us away from the concentration risk of what's been referred to as the Magnificent Seven, now probably down to the Magnificent Two. But there's very few companies that have been driving so much of that return, and that has concerned us. And so we see the opportunity in diversifying away from it, still being in the S&P 500, but doing so in an equal way, not allowing the market cap weighting to really dictate those exposures. This is some research that we saw from Bank of America in their U.S. equity and quant strategy division. And what it shows is, and somewhat suggests, is that the returns per year for the next decade for the S&P 500 aren't that exciting. And that's based on the fact that its price earnings multiple is as high as it is currently. And when you look back through history, during these periods of time where you have very, very high valuations, the subsequent decade tends to perform fairly meagerly. And so to my prior point that we've been overweight, essentially in equal weighted exposure to the S&P 500, it was very nice to see this research from B of A that equal weighting is something that they see better returns relative to the normal market cap weighted S&P 500. So we've been positioned in this way for certainly the whole of this year and most of last year as well, which means we've been lagging a bit in our performance relative to what the S&P 500 has been delivering. But we're not concerned about that. We are always looking forward and assessing that risk on a forward-looking basis. And this was nice to see from a major research shop, and so we may be early in our allocation, but we're very confident in its positioning. We don't have all of that embedded risk that the S&P 500 has, especially that concentration risk. Here's another indicator, and if you've attended these webinars in the past or watched them on YouTube every quarter, when I put these on, I often talk about the Buffett ratio or the Buffett indicator. And this is another way of looking at it. Warren Buffett likes to take the total value of the US stock market and divide it by the total value of gross domestic product, or GDP. And when you do that, you get a relative valuation, the size of the stock market compared to the size of the economy. And really, it's kind of stunning to see the valuation trends and how far from from average we currently are. So right now, sitting more than 2.2 standard deviations above a historical trend line for value. And the last time we got this high, other than basically right coming out of the pandemic, was the internet bubble, the dot-com crash. So not exactly good company to have in that way. And then you got to go all the way back to the 70s where you saw some of that occur. Now, obviously, the bottom of the financial crisis, you see that it presented phenomenal buying opportunities. So this is just an interesting indicator to check in with regularly, which we do. It may also be one of the reasons why Warren Buffett is sitting on so much cash and actually has been selling quite a number of his holdings recently as well. So, like any discipline, if you follow your discipline, you're going to be in good shape over time. And maybe that's what Warren is doing right now, is seeing that his own indicator is flashing warning signs. Certainly, we're heeding it, and we've positioned accordingly by not having the concentration risk or market cap exposure within S&P 500. And to be more specific on that, we have 0% S&P 500 market cap weighted index exposure, and choosing instead the equal weight exposure. This is an important item, and we touched on this in some of our investment committee meetings over the past 2 quarters pretty regularly, which is that most folks don't remember that we've had lost decades where the return on a portfolio essentially was flat to maybe even slightly negative. And this isn't a rare occurrence. It's actually something that shows up throughout the decades. And this happens to be published by a bit of research published by GMO. And they show these different decades going back, quite a long ways, looking at long periods of time here. But there are, in fact, big tranches of time where you can have a 60-40 portfolio, 60% in stocks, 40% in bonds, and actually have very little return, if any, over a period of 10 years. 10 years is a long time. And obviously, we have clients who are in retirement phase, or they're just nearing retirement. And to have to wait for returns for a decade is pretty dramatic, pretty painful, especially if you're drawing down off the portfolio. So this is one of the reasons why we take a very active approach to asset allocation, very active approach to how much cash we would hold during some periods, sometimes more cash, like right now. Also, fixed income is much more defensive in our portfolios currently. So we're very mindful of this, is maybe we are, in fact, in another lost decade. And as a result, we're going to be positioning ourselves away from the S&P 500 and all that concentration risk, and more diversified into other areas. That's where the opportunity lies. And just touching on this very briefly, this is interesting because it shows, once the Fed starts cutting their rates after a hiking cycle, which we've just had, and the Fed has now started to cut rates, what happens to the S&P 500 before, months before, and then after? And so this light blue line is showing our current situation. Obviously, the S&P has been doing really well during this cycle. And yet now we're at the point of cutting. And so what will happen next? Will we have a recession where S&P suffers quite significantly, historically speaking, or no recession and the S&P does incredibly well? So there's a huge divergence here. It's either going to continue to grow or it's going to collapse. And we're certainly positioned more in the camp that the S&P 500 is quite vulnerable on several fronts. And we'll share some of those items with you and why we're so defensively positioned and also opportunistically in other areas. One of which is in small cap companies here in the United States, also mid-cap companies here in the United States, and internationally, particularly developed foreign markets. You can see this correlation to the S&P 500 for S&P 500 growth versus S&P 400, 600. These are small and mid-cap indices, and emerging markets and foreign developed markets. Well, there's really an inverse correlation here between the S&P 500 and its growth bias that it's certainly been demonstrating lately to these other parts of the markets that have not been keeping up with it and actually lagging quite significantly. So if you're of the mindset that the S&P 500 will be underperforming, then these are areas of great interest. And certainly we have found great interest in them for our portfolios and have overweights in small and mid cap, as well as foreign developed markets and foreign small cap as well. Let's touch on bond markets. There is something that just confounds us and continues to make us wonder why we are seeing spreads so very narrow. One of the ways to measure risks in the bond market is to look at option adjusted spreads, or the amount of yield that you get over a risk-free rate. And historically, for junk bonds, this is B-rated paper, this is double B-rated paper. Historically, you have about 531 basis points of a spread. Pretty nice. I mean, you're getting paid 531 basis points more than a similar maturity of a risk-free bond. And right now, that's around 285 basis points. Very, very low, very, very compressed. And we wonder why that is, because there's certainly a lot of issues that we see related to the maturity wall for U.S. corporations here in the United States, a tremendous amount of debt that's coming due next year and the year after. That isn't going to be refinanced at 1 or 2%, like what most of that debt is currently. Most of these corporations are going to be refinancing at 5, 6%. So maybe that's going to put some pressure on corporations, and so certainly these spreads are indicating an unusual amount of complacency. And anytime you see something that's unusual, given the economic backdrop and the financial backdrop, that should give you some pause for concern. This may be my favorite slide in this entire quarterly presentation, and this is looking at essentially the equity risk premium, which looks pretty non-existent. And what it does is it compares the earnings yield using the S&P 500 cyclically adjusted earnings yield from Schiller, which we looked at the PE version earlier, and then comparing it to the 10-year Treasury rate, long-term risk-free rate. Well, right now that long-term risk-free rate is around 4.5%, 4.42 as of 11/18. Well, when you compare that to the earnings yield of 2.84, well, this is a way of doing an apples to apples comparison of stocks and bonds. And so when the earnings yield is really far below what you can get even in a risk-free rate, that's really begging the question, why do you own stocks? Because you can get a fair risk-adjusted return, a very, very fair and favorable risk-adjusted return by just investing money in treasuries. And so this tends to be on a going forward basis, a not so great time for stocks, because it's indicating that you're not really getting much return on your money on an earnings yield basis. And so you can see periods where this earnings yield was significantly higher than the treasury rate or risk-free rate. And this was a very good time for stocks. And so you can also see in periods leading up to the great financial crisis, where you had this essentially no equity risk premium, you had this significant differential in favor of treasuries. That led into that great financial crisis and that recessionary period. And of course, leading into the dot-com crash, you also had a very similar situation. So when you see this orangey space here, it starts to indicate be wary of S&P 500 and its lofty pricing, because the underpinning of it from an earnings yield perspective is not very generous compared to what you can get elsewhere without much risk. And of course, this echoes through the capital markets. This is looking at the Federal Reserve balance sheet, and they've been doing a very good job in reducing the amount of assets there. But meanwhile, there's been a huge tick up in the federal funds rate. Now they've started to decline. Maybe they get, to a, 3.5% level over the next 18 months or so. That's a best case scenario without reigniting inflation. But what we find very promising is that actually money supply is continuing to expand. Commercial loans are expanding. So banks are still finding ways to make loans, even with a contracting balance sheet at the Fed. High quality junk bonds had compressed actually quite a bit, while CCC remained a wider spread. And what we find now is that even CCC is now compressing and narrowing in spreads, and the higher quality junk is compressed even further. So this idea of risk in the markets is almost non-existent. That's always a big red flag for us when we see that no one's worried about anything. No one's worried about default. No one's worried about any kind of return of principal or interest payments being made by the junkiest of companies in the US economy. That's kind of surprising. Let's touch on real estate. I think this title says it pretty clearly. People don't feel like buying homes. We're at the lowest level ever in terms of buying conditions for housing. So that's pretty difficult. There is this perception of a magic mortgage rate, which is 5 to 5.5%. Right now, we're close to 7. This was done in September, which was around 6.2%. But you can see there is very little appetite for buying a home when interest rates are at the levels that we're currently seeing them, 6.78 as of 11/14. And you can see what this has done. I mean, almost perfectly with this rise in mortgage rates, a collapse in existing home sales. Absolutely a headwind for real estate. True rate of unemployment, always an important item to touch on. True rate of unemployment is around 24% in the US economy. You only see the headline 4.1%. It's important to know that when this number is published, it includes people that work just 1 hour per week. Well, at 1 hour a week, you're going to have a tough time paying your rent. So the true rate of unemployment looks at how many people are not even able to make $25,000 per year, which is the poverty line. And that's at 24%. So there's a lot of people in our economy currently that are not making money, even if they are working a little bit. China, a lot of news about China. This is an interesting graph that shows that right around the Great Financial Crisis, they had maybe 700 billion in treasury holdings that got close to about 1.3 trillion in mid-teens, and now we're about at that same level as we were over 15 years ago. So this is very intentional on the part of China to reduce their foreign holdings in U.S. treasuries. That has been happening, which is interesting because they've been a big buyer of it, big buyer of U.S. Treasury debt. So anytime you have buyers leaving the treasury market, that's tough on treasury prices. Also, from a trade perspective, and a lot of conversation around tariffs and trade wars and global trade. Back in 2000, the U.S. was the largest extra-regional trading partner for Central and South America. Well, here we are almost a quarter century later, and it's mostly China at this point, which is the largest trading partner for South America. So this is a big, big shift in global trade, and certainly will be a factor in thinking about onshoring, reshoring, and tariffs. A lot of folks around the world don't need the U.S. to trade with anymore, because China has showed up in a more meaningful way. Credit cards. You saw in our last quarterly meeting, our presentation talking about the very big increases in charge-offs and delinquencies, in particular with credit cards and auto loans. Well, here's what that number looks like. This is the net charge-offs that occurred earlier in the first quarter of this year. So these are quarterly figures of charge-offs. This is ticking higher and higher and higher with all these delinquencies. So all those savings have run out. People are now having a very difficult time paying their bills and meeting their obligations, and that's showing up in banks, and that's quite challenging for banks. And so you are seeing, as a result, now higher rejection rates. This is a natural emanation from higher delinquency rates across credit cards and loans and mortgages. Well, in fact, now banks are saying, no, we're not going to lend you this money. And this is very material and very important because the consumer depends on this to continue consumption. And if they're not able to get those loans so that they're able to consume, then consumption just stops. And a very important item to see that this is now impacting the lending appetite at banks. And just some further detail on that. The purple here is retail sales. You see that it's continued to go up during a period of high inflation, and credit card debt also continued to go up, really to meet those increased demands. And you can see, credit card debt up 33% just in the past couple of years, retail sales up 10%, but real disposable income's up only 7%. So, our estimation, our opinion is that credit cards have really been used to close the gap on all this inflation that households have experienced, and that has created this this serious issue for banks that now they're reacting to by creating more rejections on their applications. Also looking at the relationship between the federal funds rate and unemployment, there is an uncanny cyclicality to when the Fed starts cutting their federal funds rate and the subsequent time frame in which unemployment begins to surge. So this indication is an interesting one. So the Fed has begun, they're certainly seeing the data that we're referencing here in this presentation, that banks are getting more restrictive and more particular on who they're lending to. That creates a bit of a consumer crunch on consumption. And ultimately, with less consumption means less revenues. Then there's layoffs that occur at corporations. And so, in fact, you could see some very spiky unemployment in that traditional 4.1 rate that we're seeing recently. That could go to 5, that could go to 6. So something to be aware of and understand that there is some relationship here, almost an uncanny one, between the cutting cycle of the Fed and unemployment increases. And lastly, looking at, since we just finished an election cycle, looking at where are federal income taxes being paid from, which tranches of income earners. Well, the top 1% pays nearly half of all federal income taxes at 46%. Meanwhile, their share of total adjusted gross federal income is around 26%. So when you think about federal government receipts and the tax code, there's quite a lot of burden that the top 1% is already shouldering. And obviously that creates some vulnerability for these other tranches. So thinking about tax rates that may get changed and may find more participation from these lower income levels, where maybe the government that's in power will decide that they should be paying more relative to their amount of total adjusted gross income. Just an interesting statistic. Trying always to keep this to 30 minutes every quarter. That is our 30 minutes. And thank you so very much for joining me. And if you have any questions at all or would like to have further diving into any of these items, please don't hesitate to reach out to us on the contact information on your screen. Thank you.